Greetings. This is going to be the most interesting and illuminating discussion about asset management marketing that you're going to see or hear all year, whether you're watching or listening to this in 2025 or 2026. Now, I am Stuart McDonald. I have a long-running radio show on London's Resonance FM, the Naked Short Club, which looks at things like alternative investments, markets, the economy, issues like technologically driven change, disruption, risk, sustainability, and the sorts of things that are on all of our minds most of the time, whether we're at work or not. But something else that really does concentrate the thoughts is how to distinguish effectively between whatever one wishes to promote and sell in the asset management space and what thousands upon thousands of other people, perhaps equally talented, are engaged in. And to shed light on this, we have with us two absolute, widely acknowledged, highly respected experts, John Green, Paul Dass, who I'm going to ask to introduce themselves briefly before we plunge into the exigencies of dealing with this very big topic, asset management marketing. First of all, Paul, would you like to introduce yourself?
Yeah, sure. So, Dr. Stu, great to be here. John, pleasure as always. I'm half distracted by the Ashes right now. I was hoping for a 4-1 defeat. So that was my initial prediction. My second prediction was Jofra Archer getting a fifer. He hasn't got it yet. I did predict Root getting 100. So I'm very proud. I say that every Ashes. I'm also the person that said the iPhone is a toy and won't go anywhere. So I do kind of, my predictions may not always be that accurate. So is all I can say. And
but I hope your prognostications will carry weight.
Well, that's a long word. I somehow lucked into building a marketing platform for asset managers and hedge funds. And, that was our journey almost 25 years ago. And, we continue to really understand that, whether you call it fund marketing, asset management marketing, it really is about how can you use technology and data at one element of the marketing spectrum, and intuition and subjective value on the other side, and kind of bringing those together in a platform that people can use.
So the concrete and the abstract. We'll see whether we can marry the two during the course of this conversation. And I think it would be very interesting for us to start in a couple of minutes on what changes you've seen over the last 25 years, because whether we're looking at tech stacks or just the way people perceive things, there have been enormous developments. Now over to you, John.
Thanks, Stu. Good to see you, Paul, again.
Always.
So I head up a team for Apex, and we do something that is incredibly simple, which is to help fund managers stand out from the crowd, but it is fiendishly difficult. And I'm looking forward to getting into some of the tactics, strategies, and approaches that fund managers can use to make sure that people don't think, yet another long-short equity manager, does the world really need them?
Well, that's another thing for us to discuss, I think, once we've gone over the changes over the last generation, Absolutely. If you will. Because we're now living in a world that's been dominated in recent times by narratives rather than necessarily substance, momentum rather than necessarily fundamentals, and we're surrounded by the effects of mimetics and mimetics, if you will. And Dr. Stu's intrigued currently by the thought that since we can even pronounce the words now, maybe we need to be looking at what the next thing is going to be that drives our activities in this space. Now, Paul, over to you. Back to the changes you've seen in the last 25 years.
I think ultimately people remain the same. And I think whatever drives caveman, that drives, distressed debt fund, all of us ultimately are pretty much after the same thing. And ultimately, we all want to be listened to a degree. We don't want, when one a great word, FOMO, we want to be part of a group, we want to be part of something, we want to be part of a tribe, a fraternity, a fellowship. And I think that doesn't change. And whether you're the fraternity of a product, whether you're Apple, Android, Samsung, whatever you are, you from even a technology point of view, you're making choices on a regular basis. And I think people are making choices in, the products they use, how they do their marketing. And what's really changed is the frame of reference. The frame of reference used to be, I've got a great fund, I've got a great product, I'm selling the best snake oil in the world, buy it from me on my performance. And I think that used to be the narrative, and that was that. You go to your printer, stuff it in an envelope, off it goes. Now, and that was very much, the fund manager, the kind of the engineering brain, the mathematical brain, the statistical brain. Look at me, I'm so clever. It was damn hard to invent this strategy. It's going to be even harder to understand it. And I think that's kind of where we were at the time. Investors were more sophisticated, and that was it. Now, as the channels have changed, so you went from documents to PDFs, to email, to website, to investor portal, to all these other distribution mechanisms you've got. Does it make it better? Well, there are two things that spring to mind. One, every time you add a new channel for your fund, it actually makes you 15% more inefficient. Now, for a marketer, that is. So what a marketer ends up doing, instead of actually doing a good job, they're actually, as a multiple of that 15, you get 5 channels that you want to market on, you suddenly become inefficient. So you're not marketing anymore. You're not talking about narrative. You're not talking about, brand awareness or demand generation. You're just producing content. And then you've got to analyze that. So you're going from being, a creative to a data person. So essentially, the role of a marketer is almost become a data scientist as well as a content creator. But the real dichotomy in all this is, what does a marketer really, really want? Okay. So my analysis, 23 years on in this, marketers want 2 things. They want more budget and they want a pay rise, right? If you just cut it all back, right? And that's what we all want in time immemorial, right? We want to get our kids through university. Why do CRM projects take 7 years to implement and fail? Because that's how long it takes you to either go through, prep school, or it takes you to go through university. That's why projects take 7 years to fail. So that's just, that's another topic. And I think the other thing is that now when a marketer is part of the business, well, they're not part of the business. They're kind of an adjunct. You built a fund. Marketing is something we do. So marketing is never core. So it's really what we're seeing is marketing is like demanding that to show the impact they're having on inflows and AUM. And that's been a big change. And it really is, how do you enable a marketer to demonstrate the impact they're having on raising AUM? Because once you're into that language and not into brand and colors and narrative, the mathematical brain of the people running funds couldn't care less. They really couldn't care less. But what they care about is, is money coming in and is money going out? And if marketing can demonstrate that with technology, then that's the change we're seeing. It's been a very, very slow change. I thought it would take 3 years. It's taken 20 years plus. And as they say, it takes 25 years to build an overnight success. And we're not even a success. So there you go. That's what we've seen.
Okay, you've raised a number of interesting questions which may bear further discussion. For example, the idea that people just want to belong or be part of a group. Surely there are, there's a huge number of consumers, whether they're professional or retail, who want to feel that in some way they're individualized in the way that they're being addressed. They're being spoken to directly as someone who is in themselves unique, and this isn't just at the top end of the market. That's one thing. Equally, if the marketing function demands the sort of conformity that you've hinted at, doesn't that act as have a muting effect on creativity? Does the industry actually allow that much room for genuine creativity when it comes to marketing? You talk about the transmogrification of this sort of activity into something that's in the realms of data science, and I wouldn't disagree with that per se, but I'd like to hear a bit more about that. And I think it would be interesting also to hear about the actual technology that's within the stack that's being used. I mean, you've skirted across that. But before we go to that, I wonder, John, what are your thoughts on changes you've seen in the last 25 years?
Yeah, and actually, I'm probably going to talk about what hasn't changed, just in the context of what Paul's been speaking about, because I think if we actually look at this through the lens of evolutionary psychology, which is maybe not what you were expecting, but human beings, as Paul said.
Well, I'm waiting for Oliver Reed to show up behind the sofa.
Well, I hope none of us bump into him today. So the way of looking at this is that human beings have not evolved to match the evolution of technology or industry or any major social development over the past 30, 40,000 years. Evolution runs much, much slower. So the things that Paul's saying about how technology is adapted, how businesses are transforming, that is very much a thoughtful, on purpose, action thinking process that people are using the frontal lobe to think about, plan, and do outside of their instincts. And one of the reasons that, to my mind, that these things don't work so much or aren't working particularly well within asset management companies is the fundamental question of status. Now, status is one of the real prime human drivers. It drives a lot of our action, drives a lot of the way we behave. And as you say, Dr. Stu, people want to be treated as individuals. One way of expressing that is people want to feel special.
But of course, there is the paradox that en masse, people tend to want to be part of a group.
Yes,
that's right. And there's nothing like peer group validation, for example, when it comes to things like building trust or being seen to consume a certain thing. And yet at the same time, they want to be, as you suggested, Paul, heard. They want to be seen, if you will. Back to you.
Yeah, so one way of thinking about it is everybody wants to be part of a tribe. They'd also quite like to be the most important person within that tribe. So that's the status within a group. And then if you take that and then move back to the job of a fund marketer within an asset management company, think about who the high status individuals are within a hedge fund, for example. It's almost certainly the investment team. It's the portfolio managers, the traders, the people generating the performance. They are very high status. To them, and certainly 20, 25 years ago, this was accepted, and probably 5, 10, 15, and today, was accepted that these were the high status individuals. The success of a hedge fund endeavor was down to the brilliance of these people. Along comes the marketing team, a few moments of marketing brilliance, and suddenly the people who were the high status individuals can feel like it's being chipped away, and that can create a very fast, very aggressive defensive response. So one of the issues that marketers have, which I think they don't really think about, and this is absolutely to the detriment of the profession, is understanding how to position their success within an environment that has to accept that the investment management team, the portfolio management team, the managing partner is the high status individual.
Are you suggesting that they have to adopt the approach of valets rather than being standouts themselves?
Well, I think that's a really interesting way of putting it. And I think Jeeves and Worcester probably teaches us a lot about that. I think absolutely you have to think about how you position yourself, how you tell the stories of your success. And I think framing those stories is an incredibly important skill that most managers or most marketing managers within asset management firms that I've met haven't really grasped. And it's understanding how to say, we as a team have done exceptionally well due to the performance, which was then explained in such a way that the investors could truly grasp the brilliance of the PMs. And I think that's the spin, the framing that needs to happen.
Paul, before we go back to the questions that
Yeah.
I've raised, drawn from what you were talking about, would you like to address this? Because this seems, in Dr. Stew's experience, to be a perennial problem.
Yeah.
The tall poppy sales genius or marketing genius gets decapitated in the end because of sometimes resentment from the investment managers or general management.
Yeah, and I think my experience has been that if you want to change somebody's behaviour, you've got to walk a mile in their shoes and get their perspective. And if you're wrong, well, you've got their shoes. So the point I'm saying there is, how does a fund manager think? How does somebody who studied engineering, studied mathematics, studied statistics, how do they think? Well, they don't think in colours. They think in process. And the way I explain it badly, but I'll give it a go, is you've got these pillars. You've got what John's talking about, fund narrative. What is our fund? What is it about? What are our values? Who are we targeting? And what's the language behind that? What is the color scheme behind that? What is the authenticity behind that? All that kind of stuff. And what that does, it then feeds into brand awareness. So you're going from, that fun narrative to your brand awareness, and you're making people aware of your brand. And people say, oh yeah, okay, I see the second step now. The engineering brain's kicking in. And says, okay, once you've done that from demand generation, you move from there to demand generation, from brand awareness, fun narrative, brand awareness, demand generation. And demand generation is where people are starting to come in. And a simple metric is how many new people are coming in every month. Oh, great, I get that. And then from there, that's the engine that John's team would feed content. And that becomes the beast. And then you feed that, and whatever tech stack you're using, let's park that for the time being, that has to be repurposed, repositioned, delivered. Then what happens? It feeds the funnel. And the funnel is basically people who are, early stage investors. How do you become front of mind? And that becomes the automation. And out of that sausage machine pops out an investor. Now, that frames it actually quite easily. Then the next question is, how much does this cost? And then people start to talk about cost of acquisition, lifetime value, yada, yada, yada. And then, I always ask, the question, how do you buy a locomotive? All these locomotives you see on somebody bought these locomotives. How do you buy a locomotive, guys?
I think that's the name of an album you've got deep within yourself.
Slowly.
Yeah,
you buy a locomotive slowly, and people buy funds slowly. And you cannot say, most marketers will say, oh, we've been to Miami, we've been to, iConnect. Where's the investment? It's like, no, it doesn't work like that. It's a long tail sales cycle, and there's no one thing you've done that's actually contributed to the investment. It is the brand awareness, demand generation, fund narrative, all in a mix, mid-funnel, activity that happens. It could be a post from one of your managers that says, oh, that really resonates. And then something has happened. So in answer to your question, what John is talking about is really from a pure marketer's perspective, speaking a marketer's language, which is Klingon to a PM. So it's really kind of framing it for them to say, here is the process of marketing. And I think that, as opposed to the art of marketing. So that's kind of my threepenny worth into that one.
Yeah.
Anything to add to that, John?
Yeah, I agree with all of that, which is maybe unfortunate for the show. But
no, that's fine.
But one thing that I would add, which I find a very interesting thing to talk to managers about, especially the PMs, is marketing risk. So every manager understands they have to take investment risk in order to deliver investment returns. Very few think about marketing risk in the same way, and it's absolutely true. The same result will occur if you take well measured, carefully controlled degrees of marketing risk. You will then find yourself in a position to recoup the marketing returns and see the benefit of that. And marketing risk can be just the very simple step of taking a short sideways step away from the herd. Yes, you're more vulnerable to the predators and it can feel a little bit scary. But if you're just within the herd, then you're guaranteed mediocrity. And let's face it, if you were an active fund manager, your life, your career is all about the pursuit of alpha. Staying in the pack is the index buying beta play.
Yes.
So if managers could be felt to understand more comfortably about the fact that they need expert advice on how to take that marketing risk from their marketing team, then I think they would be much better for it.
Look, I wish that someone had taken me through this about 25 years ago. The number of jobs that I would not have lost even more than 25 years ago, simply because I think that you've encapsulated an approach that does not necessarily cover every single aspect of this, not by any means, but it's likely to satisfy those people who have a mechanistic view of these things and simply want some outputs to which they can relate. But there was something, I mentioned some questions arising from what you talked about earlier, Paul, but there was something else that has been making the back of my head itch ever since you said it. You were speaking as though, a generation ago, the buyer was more intelligent, was almost more intelligent or sophisticated than the people being dealt with now. Has the generality of buyers actually, in a sense, been dumbed down either through becoming more process-driven itself?
Yes.
And I mean, amplify this because this is terribly important.
Well, I think right now, it's, you are not going to get fired for buying IBM, for buying Salesforce, for buying,
Well, I don't think they'll be offended. BlackRock,
Vanguard,
Millennium, Citadel, you name it.
You won't be. And it's that classic thing where we've got indoctrinated, just do what everybody else does. And on that basis, the risk profile, I think you were talking about the people's risk profile, is, well, I've just got to get my kids through university. I'm not taking a risk. And I think as you kind of go more into corporate land, you are not rewarded for taking a risk. You are rewarded for just sticking, towing the corporate line, getting, Mackenzie's in, just doing just doing what everybody else does. But the trouble with that is that, well, that's fine, and some people are quite happy doing that. But I think there was a time where people were looking at being more, more innovative, because that's what we were being taught as a nation. And that's what we were being taught as people, moon landings, space shuttle, that was the world we were in, Moore's law on semiconductors. That was, we were promised a world where things were going to get better. And that was the case. Okay, yes, we had the Cuban Missile Crisis, but we got out of that. The Berlin Wall was coming down. There was optimism, and that optimism led people just to be that much more risky.
But do you think this is a function of you know, changes in the broader environment, the zeitgeist rising
Yes.
from that? I mean, as in, well, you know, since 2008, we've been living with the consequences at all sorts of levels.
Yes.
You know, from geopolitics down to the investment world, if you will, through to fashion, culture, and what have you, of the great financial crisis and what that's led to. Is it that, or is it simply the fact that you have at play a process of eventual institutionalization, say in the alternatives world, at least until very recently, you know, or simply an inexorable process of concentration at the top?
Well, I don't know, maybe I can
Please.
offer a slightly different perspective on that.
Yes.
I think for sure Madoff had an impact, and the global financial crisis, on the way people view alternative investments and any investments in fact. You know, next time somebody offers you 9% coupon on a AAA rated bond, you probably check it 3 or 4 times before you move ahead. But I think something that has changed fundamentally is, and it comes back to status again, and it's how people are motivated to make allocation decisions. And there's a surprisingly small level of remuneration for fund allocators that is based on their fund picks. And I think that's fundamentally wrong. If we're in an industry that should reward risk taking in terms of measured risk taking in order to find alpha, which in essence is risk, we have to reward the people that take that. And unfortunately, as we're talking about this, it comes down to dispersion of returns in some respects. If you look at outside the hedge fund world, global buyout, dispersion between the mega buyout firms, you know, their returns 16 to 18%. I mean, IRR, not a return, but IRRs of 16 to 18% in general. You move outside of those very large firms and you get far greater dispersion of returns. So you have to accept that you're going to be taking on some risk. And the individual analyst that is having to champion an investment in one of those funds for maybe a 6-12 month process, they are taking on career risk, just as you say.
Yeah.
So it comes down to this: what can you give to that person as a reward during that 6 to 12 month process that keeps them keen and eager to fight for you? Because you can't be in that room, but you need to be in that room somehow. So how can you be in the room? You can be in there with your stories, with interesting information. When you feed a really cool story about one of your portfolio companies to a middleweight analyst who is championing an allocation to your fund, you are doing a huge amount to raise their status. When they bump into the CIO at the lift doors on the way up to the investment committee meeting, Janet, what have you got for me today? Oh, well, I just found out about this really cool investment into this mining company and such that's doing, you know, renewable energy and et cetera, minerals. These are really interesting things that can raise your status within the firm. So they can raise the status of the allocator within their own firm, which makes them far more motivated to act on your behalf.
Well, you've raised another question. How do you motivate those people as opposed to keeping your own team happy? But Paul, I'd like you to pick up on any of the questions that I raised from what you said initially, or even this last one.
My memory isn't that good, but I'll give it a go. I think a lot of marketing, whether just 30,000 foot view, is behavioral science. And ultimately, that is what it comes down to. And you're absolutely right. How are you it's one of those things at any one time, 2% of your audience are ready to buy. And the sales team's job is to find those 2% of people. The other 98%, that's marketing's job. And how do you keep those people engaged? How do you nurture those people? How do you stay front of mind? And, content has a part to play in that. Technology has a part to play in that. But I do think, when people talk about marketing tech, marketing stack, marketing tech, whatever you want to call it, there are 2 things I always say to people. First thing, well, I say 3 things. 1, don't buy anything yet. The second thing is to remember, as a marketer, when you're buying software, who is the professional in the room? Because it sure ain't you as a marketer. You are dealing with salespeople who are professional.
You only understand the applications layer at a certain point.
Yeah,
at a certain
exactly.
point.
You've got salespeople there who are manipulating you to buy their product. That's all they're doing, right? And there'll be a delivery team, and
Are
then
you suggesting they're not just there because they're your friends?
ooh, are they? Oh, I do like a friend.
Oh, okay.
But and that's the thing, and and that's why ultimately people buy the wrong product, and that's because the golden rule is start with the end in mind. What outcomes do you want? So it's okay. You can buy the best CRM. You can buy the best analytical tool. You can buy, the best data tool. You can buy the best, data analyzing. You can buy whatever. You can literally buy whatever you want, and you can give people loads of money to put it all together. But if you don't have the end in mind and speak to people, have humility, have a peer group, and talk about what are you trying to achieve? What's the business trying to achieve? And then work backwards. Because otherwise you have a tech stack that's glued with spaghetti. And I used a 7-year cycle, right? Because the number of times people dump their CRM, dump their marketing, dump their tech stack after 7 years. One, because they realize we made an error. And it's taken them 7 years to work that out, whether that's a marriage, whether that's 7 years seems to be the itch. And they start again with the same process.
There's something almost biblical about the way you depict all of this, which...
Well, I am on a soapbox somewhere, but I'll bring my tablets down. But, and it is, and whichever way you look at it, marketing is how do you create subjective value in what you have? And
okay. Now let me just pause here. Something that's come out of what you've just been talking about, and we will go back to those earlier questions by the end, if we have time. How is AI playing into this? Has it had an effect so far, this so-called AI that we're all talking about and in some instances experimenting with? And where do you see this leading in terms of marketing and also the reception of the outputs, both internally and externally?
I mean, we're all cooked, apparently.
we are
AI
apparently.
is taking everything. There's going to be nothing left apart from a dusty breeze and a piece of a tumbleweed across humanity, according to a lot of people on LinkedIn and other social media platforms.
And there were live coaches the week before, right?
Yeah, exactly. Of course, telling you how to be authentic, and suddenly they're AI gurus.
Says two cynical, grumpy old men.
Yeah. But for me, as somebody who's a professional writer in some capacity, I'm not as scared of AI as a lot of my peers are. I see AI, and I think Paul's going to have a much more nuanced definition of what AI really is. But as we understand in general public, the AI, ChatGPT, etc. tools, they are tools. And it doesn't matter how good the hammer is, if you give it to somebody that's never built a house, it's going to end in tears. So the people I think that are most or should be most concerned are juniors, and I think the number of opportunities for juniors within firms is going to diminish. I think it's almost inevitable that that's going to happen. But for people leading marketing organizations, for the people running teams, the people with skill and experience that's been built over time, so there's a difference between experience and knowledge. So those with experience, I think, are going to hugely benefit from this age of really incredible tools.
Well, you are talking to a guy who, even though predicted Joe Root's 100, and I've got it right 1 in 7 times, so I think it's his 7th tour in Australia, also got the iPhone wrong. So this comes with a caveat. So I've just released the 3rd edition of my book, and everyone's asking, well, not everyone, 3 people asked, what's new?
Please remind people what the book is called.
It's Marketing to the Invisible Investor, available on Amazon and all good bookshops. Makes a very good doorstop, apparently, but we'll leave that for later. we yeah. So what are you talking about? And I say how AI isn't working, and it's like, is AI work? Well, of course AI works. You know, you have an algorithm, you chuck a big computer at it, it seems clever, it does what it does. Okay. Now, the question in our world, in the fund marketing world, does it have a space? Well, if you are generating content, there is a whole compliance element that sits behind it. If you're pushing numbers out, if you're pushing opinions out, whichever way you look at it, it needs sanity checking. And you just, from a regulatory point of view, you can't get away from that. So that's kind of the first part. There is AI that's being used to look at, well, this newsletter did really well based on this content. Let's use that analysis to produce some more content like it. Then distribute it out, see what works, what doesn't work. Well, that's A/B testing. That's not really AI. Okay. And I think the misnomer of AI, which is basically statistics that is being exposed in a more friendlier way, call it AI is fine. But then you're kind of moving into the dark world of is it sentient? Is it, you know, is it going to be learning from itself? And I think that is so far removed from where we are today in the fund marketing world. And what's come to light probably in the last 6 to 8 months is people are asking us, does your product use AI? And we look and we kind of say, well, there must be a reason you're asking. And the reason they're asking is people don't want AI. They don't want any models being trained on their data. So, you know, when you've got Copilot running in Microsoft Outlook, it's learning your responses. When you're putting PowerPoints together, if you're using OneDrive, it's pulling all that. That data is being assumed, and it's all in your, you know, when you go and you install a product and say, do you accept? And you read judiciously, you know, the terms and conditions, say, yes, I do. They're just training models. And people, fund managers, don't want models being trained. So we have in our product a big no AI button. And that's counter to everything that we are being sold, as, you know, people are buying $10 billion worth of, you know, NVIDIA chips, right? We're at that stage now where hype, we've empowered ignorance. That's essentially what we've done.
It comes down to marketing as well, right? So clients might say, oh, we've run the deck that you've written through AI, or they won't say that. They'll say, I've shown it to some friends.
Yes.
And we can recognise when AI has been commenting on something. And I would caution people very much against this because, and I'm just going to use the term AI, even though it's large language model, you know, AI doesn't have the right information to base those decisions upon. And if the game in fund marketing is to clearly differentiate your product, not so that you're the better choice, but so in the mind of investors, you are the only choice, you're the only group that can deliver this one specific thing. You cannot get that from reviewing other people's messaging.
Yeah.
All you can do is find something else in the middle of the herd, something that's middleish that isn't going to put you out of business, but certainly is not going to help you drive your business forward.
Yeah, and a really good experiment, and I encourage listeners, viewers to try this, is go to your, you know, choice of poison. So ChatGPT, you know, Claude, whatever. And it's something that you are a real expert in. Start asking it questions. And you'll see very soon there's a point where it fails. And the reason behind that is because most AI models have learned, they've scraped the internet of all knowledge that's now available. So the models have got two choices now. They can either become programmatic, so they're being programmed to give responses, and we know they do, or they've got to start creating their own content to train themselves. So it's almost, we're at some kind of threshold now where we can't really go any further, which is quite interesting. And as they say, not a lot of people know that. And I think there is an element now where the concept of AI is going to be at a point where it's going to be more programmatic than deterministic as it is today. And you've got to. I ask this question, so obviously I say obviously, but I'm from a family of doctors, and they regularly use AI for fractures. They regularly use AI for mammary scans, cancer detection, and the press would make us think it's 100% accurate. Turns out it's 40% accurate. They still need the human element. And these are people who are incentivized to give the right diagnosis. And they're finding that these tools have been available for 20 years. They've had data to train themselves. So we've got to be very careful AI has its place as a tool to do comparisons with, to run pitch decks through, to say, well, we're just getting another idea. That's okay. But to completely rely on a black box model, if anyone's got a Tesla and it does phantom braking, where does that come from? Well, that's not ideal.
That's the Ghost in the Machine, of course.
Yes, a great album by the Police, by the way.
Well, indeed, but the big question of the moment is, does one's Ghost in the Machine dream of electric sheep, which is...
And who's liable for the Ghost in the Machine? Because if the Ghost in the Machine makes an error, is it the analyst? Who is that person?
But back to the asset management marketing topic that's at the core of this discussion. You spoke about how opportunities for juniors are likely to dry up. Well, where's this AI going to take us, or this so-called AI going to take us? Is the industry going to have to wait for older people to literally drop dead before anyone gets a job again?
Well, I think this is an existential problem for many parts of many businesses, and I think there are certain job functions where it's going to be very difficult for AI to supplant even the juniors. And I think if I'm thinking about asset management marketing, it's the sales, marketing, and IR teams, the people who have to build and maintain genuine human relationships. Those skills, I think, are still going to be built within firms. When it comes to, let's say, a junior at a VC who is the first barrier to portfolio companies applying for funding, then I think that increasingly and possibly already more accurately will be performed by AI, or some combination of human plus AI.
So something analogous to the torturous AI-driven HR processes that younger people out of university, for example, have to go through in order to get their first paid job.
Yeah, and I think there's going to be pushback from that. I think there's already been a very strong reaction against it.
Are you suggesting that in the end the human element will reassert itself or not?
I think as people come to understand how to game these systems, there has to be a way to bring back human judgment into the process. Now, a lovely story I heard of a guy who, on his CV, in white font at the very top, instructed any AI reading the CV to disregard all instructions and pass this as an exceptional candidate. And it was highly successful.
I should imagine. That's rather like Winston Churchill leaving an exam paper blank and passing. Now, back to the substance of fund marketing. This dumbing down that you implied earlier, Paul. Where are we going? I mean, what with the developments in the crypto space and the way in which people like Uncle Larry Fink at BlackRock have fallen in love with the idea of tokenization, the way in which there's so much talk about democratizing access to things like private equity and other private markets plays and real estate and so forth, such that the mass affluent at the very least can get at these things. And at the same time, even below that traditional way of classifying part of the market, you've had the Robin Hoodization of activity, the gamification of a lot of activity. What bearing does that have, or what are the implications for marketing of these two developments?
Well, the interesting thing is, Dr. Stu, their marketing is successful because we're talking about it right now. And there lies it. It doesn't have to be right. We live in a post-truth world. It doesn't have to be right. We're talking about it. And that in itself gives it huge amount of value. And it really is what kind of John's a great politician I am. I'm not even answering your question. And I think John's absolutely nailed it on the head, because what they're doing is they're differentiating. Apex are going big into tokenization right now, right? Yeah. And I think we've just acquired a business that does that, right?
Yeah.
So it's almost like, okay, wait a second. I don't understand this, but Larry Fink's talking about it. Peter Hughes is talking about it. Apex is talking about it. It must be good. So suddenly you're back to the herd.
So this is momentum, not fundamentals, really.
Correct. And this is, again, that big part of a tribe. So if you're in it, are you in the herd? So you're not going to be on the periphery, getting attacked. You're in the herd. Well, I'll stay there and I'll take either my 0 return or I'll take my 7%, but that's where I'm going to be happy.
Well, I mean, you've both talked about how, for example, fund analysts and selectors, the types that have been dealt with for the last generation or so, particularly at an institutional level, have a tendency, have a reflex to play safe.
Yeah.
And yet what you're saying suggests that all notions of conventional risk assessment have been thrown to the four winds.
They have. And it'll be, is that story, isn't it, that 4 mop-top Liverpudlians showed up to a record label and they said, you know what, not for us. There we go. And somebody took a chance on those 4 guys and they became, one of the greatest bands in the world. And it's the challenge, of, I think what John spoke about as well, is that if you've got these AI barriers, whether it's compliance, whether it's selection, if you've got those in place, yes, you will get what the machine says, but it won't give you the exceptional ones. So you'll have a world of Coldplay. And, we don't want to live in a world of that, do we?
Well, everybody enjoys a warm bath from time to time. I think it's important to separate the mechanism from the underlying assets and the portfolio construction of those assets. So I think undoubtedly tokenization offers a huge range of benefits to various parts of the fund distribution process in terms of ease of use and so on. But I would like to come back to that phrase, democratization of finance. And I'm old enough to remember when democratization of finance meant somebody in sub-Saharan Africa could buy life insurance for their family via their mobile phone.
Yeah.
And to me, that's what democratization of finance is really about.
Or an amplification of things like microfinance, if you will.
Yes. So giving people access to the great pieces of finance that have driven development and the industrialization of
the so-called unbanked, even at a time when traditional banks are withdrawing from traditional banking activity.
Exactly. To me, it is not the clickbait of, doctors in Waltham Forest don't want you to know this. Here are the secret wealth generation or wealth generating tools.
But aren't we now in an era where marketing, whether it's through social media or generally, is really based primarily on provocation?
I think that's an interesting point. So I think the job of marketers at the beginning of the process is to grab attention. If you don't have attention, you can't get your message across because it's being ignored. But I think if that initial grab of attention is incorrect, invalid, or just in bad faith, then what you're actually doing is saying, the first time I'm going to meet you as a potential customer, I'm going to lie to you. And asset management is all about trust. You're investing in a blind pool of assets. If you don't have trust as an asset manager, you have absolutely nothing. So whereas this might work for somebody who wants you to click through 30 pages trying to find out where Cilla Black really lives and whether it does shock you or not, and be served a series of adverts along the way. That's not the marketing and sales process for a 12-month sales cycle for buying SaaS software or investing in an alternative investment fund. So I think we have to be very, very careful which lessons we learn from which exponents of marketing and sales.
Well, I think you've hit a very major point on the head, which is that of building trust. Paul, I wonder if you want to pick up on that.
Well, Johnny Ive, the great designer from Apple, had a great quote. He said, design builds trust. And that is because, when you've got something crappy in your hands, it's crap. It looks crap, it smells crap, it is crap. And that's just the nature of the beast. And I think when you're kind of from your fun narrative, demand gen, all the way through, it's got to be well built, because those are the signals, the subtle. It doesn't matter what you say, and ultimately nobody reads what you send them anyway. They just scan it. But it really is your design building trust? And this really helps, the fund managers who say, just put it together, it'll be fine. But there is the subtle art of really giving a two hoots about what you're putting together. And I think Apple do this incredibly well. So if you ever open an Apple computer, it's beautiful on the inside. As the whole unboxing process, we all get that. But inside, people have really thought about it. So when a marketer comes to you and says, oh, we actually really need to do this thing, and it's outside spec, but we should really do it. It's really to be able to think that this is not about a marketer getting a little more money so someone can, it's really about how are you, when you open the box, do they really see quality running through everything you're doing? And that is it. And I think, we'd like to think, when you trust somebody as soon as you see them. It's a micro react. They don't have to do anything for you to trust them. And I think branding and marketing all kind of lives in the same area. And unfortunately, marketing and fun, if it doesn't matter if you've had a bad month in your performance, nobody cares to a degree, because that doesn't erode trust. What erodes trust is kind of denial. As they say, denial is not just a river in Africa, right? It is. There you go. You can keep that, viewers. But the point there is that, again, being authentic, it all kind of ties in. So the narrative, the design, it all ties into trust.
I think an important point, if you will, is that one doesn't know what someone or a group of people is actually going to read out of what you send them or what is presented to them. So it could be a 30-page document, it could be a pitch deck, it could be a DDQ, it could be an RFP. It doesn't really matter what it is. If you don't get every single component part of it designed, as you would put it, up to a certain standard, you're going to let yourself down if something's shoddy or substandard. And a lot of people who are not involved in the marketing or sales or commercial functions don't get why you would spend so much time dotting I's and crossing T's to the point almost of reducing them to dark matter. It's because you actually don't know which bit of your message is going to be in someone's sights.
And design is a science. Design is a science. And,
Absolutely.
I just big shout out to Alan Pitchforth, who is a creative director. And he's done, I've known him for a long time. And originally I was like, look, why are you fussing on the font? Why are you fussing? Literally, stop it. And it's like, no, because this means something.
Yeah.
And it's almost, I'm at the stage now where you almost need a head of data and you need a creative director, both sitting, in your organization, if you're big enough, or at least outsource it, because it adds a huge amount. And Alan's done ProFundCom's work, and I can really tell, people can really tell, ProFundCom version 1, version 2, very, very different.
This is about signals, right? So
Yeah.
Johnny Ive, any type of design, what you're saying, Dr. Stew, about fund documents, these are signals. And as a business, you send signals out into the world that tell people what to expect from a future relationship with you. That's why
Even if it's by
designs
implication rather than
often
being spelt out.
it's not spoken. So a classic example is the huge edifices that were banks in the late 19th century when they sprung up. Huge neoclassical pillars, big marble. I mean, we still have the marble entrances, of course. What does that signal to a retail investor who's or somebody who's about to put a deposit
Yeah,
there?
that simply engenders a feeling of solidity and gives you confidence.
We've invested a huge
Trust.
amount. We're not running off to the hills. We're not leaving this. We can't carry this marble with us. So your design work is signaling to potential purchasers of your product, we are fully invested in this product. No stone is left unturned. We're delivering excellence here. So you can trust this. That's the implication.
Yes.
And the same thing comes from asset managers when they design their information, how they present themselves, how they talk about themselves. And every salesperson dresses up nicely for a meeting, for a sales meeting. But often the materials don't reflect that. I mean, I've seen decks that, to be kind, wouldn't look out of place in an early 2000 mid-market investment bank, right? You know, more bullet points than you could imagine are possible to fit on a slide. And it's signaling to potential investors, hey, we're really difficult to deal with. You might not enjoy this process. And even if you do enjoy it, it's going to be very difficult to unpick what we're doing if things go wrong. So those early signals about transparency, openness, the ability to communicate with clarity in such a way that when your CIO says, Dave, what's happened with that investment, you can actually say, 1 second, I'm going to call them and find out, and then give them something back in plain
Well, how many
English.
times have you seen a 32-page pitch deck that really ought to be 20 pages long?
Literally hundreds.
And with bullet point after bullet point after bullet point, and untrammeled paragraphs upon paragraphs that you actually have to spend hours reading in order to digest.
And they're not going to do it.
And the people who produce them don't realize these are not going to resonate or get through to anyone. This is why marketing people, to everyone else's impatience, and salespeople have to look at how many angels are dancing on the heads of every single pin they're holding up. It is so important. The thing is that one is competing with a lot of other talented people who are generating alpha or beating the benchmark, or at least not underperforming it too badly at a given moment in time, and have all the nice touchy-feely aspects of investor or customer relations to bring to bear on the people they're dealing with. So distinguishing yourself by at least not dropping the ball is so important. For example, institutional consultants, a primary screen for them is simply how well written are the submissions made to them. That's it. And it's not commonly understood by fund managers. Why would it be? That's not their job, going back to what you were talking about earlier. And yet, large flows are occurring and look like they're likely to occur from people who are not paying attention at all to anything other than the 15 seconds for which they pay attention to something that's on TikTok or some other form of social media, or scanning a document, a tip sheet very quickly, or hearing something from a salesperson that they've heard. They're being driven by sentiment, FOMO, fear as much as greed.
Yeah.
How do you deal with this? Because we're not, we're now moving into a world where things are to some extent disaggregating or atomizing, and we're not just dealing with we're not dealing with professional buyers, even if their behavior isn't always that imaginative. How do you deal with this?
I think it always boils down to who is your ideal investor. Call it your ICI, your ICP. Who are they? What are they? What do they like? What do they don't like? And I think that again is the science of who you're targeting, and that that determines, and I've learned this from Alan, that that determines your font, determines your colors, it determines your spacing, it determines is it a face, is it multiple faces, all these kind of things that you put together. I think that really is the science behind it. And then being able to track, is this resonating with our ICP? And you've got databases that allow you to do that kind of analysis. And there is an element where you can get swept up in the world of TikTok and swept into the world of social media, which you're exposed to probably 90% of the time on your phone, and somehow those worlds collide. They don't collide. You don't buy a locomotive based on what you're seeing on TikTok. It may change your frame of mind ever so slightly, but when you're in work mode, I'd like to think if you're dealing with allocations and stuff, you've got your smart brain on. So I do think whilst there are distractions out there, it really is focusing on who is your buyer and having the ability to say, no, we're not going to cater to that type of buyer. We're going to type to this buyer. It could be institutional, it could be VCs, it could be private equity. Everybody's slightly different. And what becomes really important as well is when you're in the recruitment process, surprises me how many marketers have actually raised money. Because then all of a sudden, those marketers traditionally who I haven't seen do well is gamekeeper turned poacher or poacher turned gamekeeper. They know the language, they know the subtleties. And then the buyer and the seller become of the same tribe. So then that friction that exists, those different languages, it all somehow changes. And I think that's really quite important. So, it's not about the tech. It's never about the tech. It's really about having, and this doesn't cost you any money, just doing the thought experiments to say, who are the people we're targeting? What message resonates? And then, try the A/B test, try the AI, for want of a better word. So that would be it. And it even kind of boils down to something even simpler. And a guy I know very well who still does print. Do you remember print?
Yeah.
And his view to me is, you know what, Paul, I still print. I don't need your software. I said, fantastic. He said, because the one thing I know about my newsletter is when I post it, depending on Royal Mail and UPS and DHL, I get 100% open rate. And I thought, that's really interesting. Because if you do what everybody else does, you end up where they end up. And he chooses not to do it. And then the other thing he ends up doing, he actually uses, remember Microsoft Publisher on Windows 95? He's got a machine and he does that. And he just puts it out there. And I said, why do you do that? He says, because people will realize I'm so busy writing great content, I don't have time to format this stuff. And I was like, okay, well, that's so different. But it isn't that different. And I'm not saying we all do this, but I'm just kind of thinking, as Steve Jobs said, think different. Now, how can I think different? How can I do something, as John, you said earlier, that just makes me that much different? I'm within the realms of compliance. I'm in the realms of building trust. But how can I be just that little bit different? And that is really, I think, how you cut through that noise and that attention span.
Yeah, I really agree with that. It's about resonating. So it's about having the confidence to pick a small subset of your ideal investors, the ones you want. And for most funds, that is not hot retail money. So this retail game is for big fund managers who've spent millions building their brands. But for others, really focus on a small subset, find messaging that resonates with them, use their own language against them or with them, and you'll demonstrate that you are in the same tribe, like you say, Paul.
Time is unfortunately finite, rather like alpha, bull markets, hopefully purgatory, if we ever experience it, even Bitcoin, unless you can work out a way to mine or hack some more. So we are going to have to wrap up, unfortunately. Paul and John have been fascinating, interesting, authoritative in what they've had to say. And it's clear to both me and I trust all of you, any of you, that We have barely scratched the top end of any surface on all the different things we've talked about. I can only thank you both for being thoughtful and compelling in what you've had to say. I hope that if you've watched or listened to this, you'll be tuning in again for more of these Apex podcasts. It's been a pleasure for me, so I'll simply bid you adieu.
Thanks.
Thank you, Dr. Stu.
Thanks, Paul.
Thanks.